Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. Today I want to talk to you about your credit score and your credit report. Why is your credit score important? If your score is high, then a lender can safely assume that you will generally pay your bills on time, so they'll want to have you as a customer. If your score is low, they'll assume the opposite. If you'd like to rent a really nice apartment or get a mortgage, and especially get that mortgage at a low interest rate as a low risk of default, then look after your credit score. And it's not just real estate. Credit scores get used by a lot of different entities. Landlords often ask about their applicants' scores to see whether they'll pay their rent on time. Utility companies will check residents' credit scores to determine whether or not they require a security deposit. Insurance companies of all kinds will check whether you pay your bills, and you may end up with a higher premium if you have a poor credit rating. Car insurance companies have found a correlation between people wrecking their credit and wrecking their cars, apparently. Even cell phone providers inquire about credit scores before approving a contract for the new iPhone XYZ 100 or whatever the latest iteration is that we're on now. Are you starting a business? A good credit score will also help. Your credit score is simply a measure of trust. The higher your score, the more trust lenders and institutions will have in your ability to pay them back. A good credit score can help you improve your financial well being and make getting a mortgage, buying a car, or starting a business a lot easier and cheaper. In Canada, our credit scores range from 300 to 900 according to Equifax, one of the two Canadian major credit bureaus. TransUnion is the other. I should mention that all the other credit companies get their information from either Equifax, TransUnion, or both. Every lender has its own criteria, but a good credit score should be anywhere above 660. The higher your score is, the less the lender sees you as a risk. However, each financial institution has its own criteria and rankings for high and low risk borrowers, and all lenders will look at other information in addition to the credit score to make a decision. There are also different credit bureaus and different scores. 741 or more, you have an excellent credit score. 713 to 740, you have a good credit score. You should expect to receive very good interest rate offerings in a variety of credit products. 660 to 712, this is considered fair or average to lenders. But once you get to 660, you're entering into average credit score territory. 575 to 659, this is below average credit score. 300 to 574, your credit score is poor and needs improvement. You're considered to be a high risk borrower, and if you are approved, you could end up paying a lot in interest. The average score in Vancouver is 687, Victoria and Toronto are 670, and the Canadian overall average is 649. So what makes up a credit score? As the chart shows, your credit score is affected by payment history, credit utilization, credit history, credit mix, and your number of credit inquiries. The number of credit inquiries is 10%. So you would want to limit how often you apply for new credit. Credit inquiries account for 10% of your overall score, and credit agencies will review all of your requests within the past 6 to 12 months. Credit mix is 10%. So this is the different types of credit, and they carry weight in different ways. For example, paying a mortgage means that your amount owed decreases monthly, whereas paying a credit card is seen as a higher risk loan by credit bureaus because the number can increase or decrease daily. Having diversity within your credit rating is 10% of your overall score. In comparison to the other factors, it's not as high, but every percentage point counts. Different types of credit include student loans, car loans, mortgages, home equity lines of credit, unsecured lines of credit, credit cards, and utility bills. It's not recommended you open new accounts to create diversity unless you're planning to use them. Generally, if you stay responsible with your money, your credit score will be good. The credit history, or the length or age of your profile, is 15%. The 15% is based on how long your accounts have been open, whether they are active. To create a solid history, credit bureaus would prefer a minimum of 6 months of credit history, and some lenders would require 12 months or more. Therefore, before you close a credit account, research whether or not this will affect your credit history. If you'd had one card for 10 years and another for 5, your best option would be to close the 5-year account as it holds less credit history. Creating that credit history takes time. Credit utilization is 30% of your credit score. Try to keep your credit utilization, which I will talk about later, below 30% of your available credit. You should generally avoid closing long-standing accounts since that lowers your available credit limit as well. Ranges of credit utilization are 0 to 9%, 10 to 29, 40 to 69%, and then 70% or over. Try to stay under 30% of your available credit limit, even though Equifax recommends that you keep your credit utilization below 75%. Some studies have shown that strong relationship exists between low credit utilization and high credit scores, with the highest credit scores having 20 to 30% utilization. One way to control your credit utilization is by carrying small balances that you are able to pay off every month. This will demonstrate your financial responsibility and in turn boost or maintain your credit score. Payment history is 35% of your credit score. Get a plan in place to get back on track to pay bills on time or set up an automatic payment if you are worried about your payment history. Let's talk about the importance of on-time payments. You may have heard that making on-time payments is the key to having a good credit score, but just how important is it to make your payments on time? If you've made the mistake of missing payments in the past, what can you do to help improve your credit score now? Also known as payment history, it makes up 30% of your credit score, the most of any category. The typical timeline goes as follows: 30 days, 60 days, 90 days, 120 days, 150 days, and then the debt will be written off as a loss and categorized as uncollectible. It's extremely important to keep up with the payments or be aware that you are late. In addition to negatively impacting your score, chronically missed payments may lead to higher interest rates, late fees and penalties, reduced credit limits, and even court judgments. So what if you are struggling to pay on time? If you know you're down to the wire on a payment, call your credit card company. On some occasions, if you advise them in advance that it might be late, they can make a note on your file. And if you have it, providing the payment confirmation number from your online banking may help you too. You can also look at options like payment deferrals and refinancing. Both are better options than being late or missing a payment. So how to practice better financial habits? If you had missed a payment or two, it's essential to focus on practicing better credit habits going forward to help you improve your credit score. Once again, you should generally avoid closing long-standing accounts, since you lose the payment history on that account and you will also lose the credit limit. Making at least occasional purchases with a credit card is also a good idea, especially if you've paid off all your other debts, as a lapse in credit activity could hurt your score. Let's talk about some ways to improve your credit score. You would want to check and review your credit report frequently to ensure there are no errors and monitor accounts for fraudulent activity. You want to pay all your bills on time to avoid penalties and delinquencies. You can set up automatic payments. This can be done with your bank. The caveat is that you need to make sure you have enough money in your account, otherwise you could run the risk of getting hit with costly bank and insufficient fund fees. Also, you can make a budget to track your bills. Write down all of your current monthly payments, including interest. You should prioritize paying off the higher interest debts first. If you find yourself paying a very high interest rate on your debt, it may be a good idea to move it over to an account with a lower interest rate if possible. Then start making scheduling reminders or notifications in your phone or calendar. For example, if you have a credit card with a 20% interest rate and you're late on payments, it may be in your best interest to pay off this debt with low interest personal loans. Then you can pay off the debt quicker thanks to the lower interest payments. If your biggest obstacle is forgetfulness, you can also try and pick one day each month to pay all your bills. However, this tip might not be feasible if you have irregular income or unpredictable cash flow. Pay down any revolving debts to reduce credit usage, i.e., credit cards or lines of credit, and keep credit balances low. Make more than the minimum payment on your credit card bills to reduce the balance faster. Be cautious when seeking additional credit and taking on new credit. Variety is the spice of life. Ensure you have a good mix of credit products. Ask for a credit limit increase to keep your utilization under the 30% I had mentioned. Credit utilization is the amount of credit you've used out of the total amount available to you. So, what is the credit utilization rate? Let's get into some details. One of the most important factors that can affect your credit score is credit utilization, but many Canadians don't know what it is. Did you know your credit utilization determines 30% of your credit score? If you're looking to understand and improve to buy a house or get a loan, you need to pay attention to how much of your available credit you are using. So, how to calculate the credit utilization ratio? Your credit utilization is the amount of credit you've used out of the total amount available to you. The lower your credit utilization, the more attractive you are to lenders. You can figure out your credit card utilization in Canada by dividing your total credit card debt by your total limit. For your overall credit utilization, just add up all your cards and lines of credit, including home equity lines of credit, and divide them by your total credit limit. For example, if the balance on your credit card is 500 and your credit limit is 1,000, then you have a high credit utilization with a rate of 50%. I recommend keeping it below 30%. So the 4 steps to calculate your credit utilization rate. Step 1, tally all your balances from all your credit cards. Step 2, tally the limits you have on all your cards. Divide the total balances you have by the total credit limit, and then multiply by 100 to get your ratio as a percentage. But why does Equifax look at my credit utilization anyway? Well, carrying large balances on your credit card suggests you're not able to pay them off in full, and credit bureaus see this as an indication that you might have problems paying bills in the future. If, for example, you are relying on your credit to cover your regular expenses, once your credit cards are maxed out and the lines of credit are used up, you may not be able to cover the loan payments. So, what's a good credit utilization ratio? Once again, I would recommend keeping your utilization below 30%. Credit providers and financial institutions will see you as a responsible credit user. So if your credit card limit is 5,000 and your balance is 1,250, your utilization is 25%. How to improve your utilization ratio? There's 2 main ways that you can improve your credit utilization, and luckily they're pretty simple. Number 1 is minimize your account balances. The best way to improve your score is by minimizing the balances you owe on your credit card accounts. To do this, you should simply try and pay off your balance in full each month. If you're finding yourself having trouble meeting your monthly bills, you may want to consider debt consolidation or low-interest personal loans. Loans don't count towards your credit utilization because they're a form of installment credit. You're approved for a set amount which you pay off through fixed payments over time. Since credit card interest on missed payments usually exceeds 20%, you'll likely receive a lower interest rate on a personal loan and save money in the long run. Another way to improve your utilization rate is to ask your credit card company to increase your credit limit, or you can apply for another credit card. This is called a balance transfer. If you can handle credit responsibly without overspending, this is a great option. The goal is to increase the total amount of credit available to you and not to add to any existing debt you already have. So what's a balance transfer? A transfer balance is what you repay or transfer one credit debt to another card. There are 3 reasons you might want to consider this as an option. The first reason is that you can perhaps get a lower interest rate on another card. There is a card with a higher credit limit available that can accommodate your old balance, and you can receive favorable introductory offer that provides you with time to pay off your existing debt. Just pay attention to the fine print and possible increases in the interest rate. Number two, if you're transferring between existing accounts, it typically doesn't affect your credit score. However, if you open a new card, the average age of your credit account will decrease. And then finally, number three, credit history is part of your credit score. However, payment history and credit utilization have a bigger impact on the scoring model, meaning a balance transfer may be a good option depending on your situation. So the bottom line, if you are looking to improve your credit score, is that there are lots of ways you can start building positive financial habits and a more stable financial future. I also find it ironic, by the way, that to lower your credit utilization rate to improve your score, you need to apply for more credit, which dings you for having additional credit inquiries. Just a thought. As usual, if you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.